So lumping a whole year into 15 minutes, quite the challenge, but we'll try to see what we can do. Just want to remind everybody, feel free. There should be buttons for you to jump in the chat, ask any questions, paste your questions in there, and we'll try to get to them on the call. If we don't, or if they're more personal questions that need to be taken offline, I'll certainly reach out to you afterwards. A transcript of this will be available to you on Friday, as well as a video recap. Okay, so let's jump in. The title is somewhat tongue-in-cheek, but I think everybody kind of feels like 2023 really went pretty quickly in most cases. Seemed to fly by, certainly as the holiday season was upon us. And what really happened over the last year, and then we'll try to take a peek in the always tricky crystal ball and see what is going to transpire over the next 12 months. There's a really great article recap of the year from Dave Barry and the Miami Herald. I'm going to post that to the chat when I can, and I recommend that article. It'll be in the recap as well, because it's a good humorous look at the year that was in 2023. If you remember back in January, the big news item was classified documents. We're going to see that's a recurring theme over the last year. In February, February was a lot of fun for a lot of folks tracking spy balloons, if you recall that. And then in March, we got kind of the first economic news that was the big news of the month, and that was RIP SVB, or the death of Silicon Valley Bank. Not just Silicon Valley Bank, but a couple of others tied to the crypto market that didn't make it through the year 2023. In April, we had Air National Guardsmen sharing top secret information. So again, that reoccurring theme of classified stuff getting out there into the general consciousness that probably shouldn't have. And then in May, we had our first debt ceiling calamity, again, where we chose to kick the can down the road a little bit. So as we knew at the time, that would come back again in 2023. And then in June, we had a potential coup in Russia that didn't really work out the way anybody wanted it to. In July, had people up on the Hill talking about UFOs for the first time. In August, the credit rating Fitch came out and said, you know what, Americans, you're really bad at managing your budget, and really bad at actually creating a budget that you stick to. And they were talking about the government, but it probably goes for a lot of households as well. So they chose to downgrade our fiscal credit rating. In September, that can that we kicked down the road came back, had another fiscal crisis with another potential shutdown looming of the government. And then in October, some gridlock with Congress, as they couldn't choose a speaker. In November, things started to pick up quite a bit. We had a print on the CPI number, which really impressed at least the market. And you'll see in some of the charts we'll take a look at, was really an impetus for the way the year closed out. And then finally, in December, Santa Claus coming to town, at least for most. And we'll take a look there at what the charts say as far as the gifts that were presented towards the end of December. Let's take a look at some of the charts that we think are important. First one's total federal debt. If you are out there and you're looking at your current tax situation and you're thinking, I wonder which way tax policy is going to go in the future. I wonder if taxes will go up or if they'll go down. Well, I think we can probably say with some degree of certainty that taxes are not going to go down from where they are. With the amount of federal debt that has accrued, or especially over the last few years, you can see a big jump up during the COVID years. It's going to take something in order to pay that debt off eventually. Also, what happened to inflation in 2023? Why did we see so much on the inflationary cycle last year? Well, you can look at the velocity of money. That's what this chart is taking a look at. And it's showing you how big that velocity of money jumped up in the COVID years. Yeah, it was increasing before, but this is a massive increase in this area in velocity of money, where you had not only the Federal Reserve printing or creating money, but you had government spending it hand over fist to try to prop up the economy. This, believe it or not, this little area right here is one of the biggest declines in the velocity of money since the Great Depression. So this is the reason right in here why we got from almost 10% inflation back down to about 3 and change. Okay. However, I would, point out to you that this is still a lot of money sloshing around in the system that otherwise would not have been there. So despite this change in the velocity of money, which is a good sign and has, again, got us back down to 3%, there's still a lot out there that is going to have to be worked off for us to get back to what the Fed would consider a normal rate of inflation. All right, so some of the summary charts on what we saw from the markets last year. I put this one up on my website all the time. If you get a chance to go on, it's part of our weekly series that we send out as well. There's a link to it. And really, it's meant to show you 4 things, 4 types of investors and how they're faring over a certain period, okay? And in 2023, these types of investors were aggressive, marked by the S&P 500, and that's the green line. The blue line is your moderate investor, and that is AOM is a ticker that is a moderately allocated index. So that could be like your typical 60-40 investor out there who has 60% stock and 40% bonds, like a lot of the Vanguard products or other balanced funds do. AOK is your conservative fund. So that's going to be more like 60% bonds and 40% stocks. And then you've got AGG, which is the U.S. Aggregate Bond Fund. So you can see a pretty big disparity there for 2023. Stocks, if you're looking at the S&P 500, up 26%. Your average moderate investor up 12%. Your average conservative investor up 11%. And your average bond investor up 5.5%. Why that disparity? Well, we talked a lot about it towards the end of the year. And here it is again in a graphic format. So if you look at this orange line for 2023, this is FNGS, okay? So this is your Facebooks, your NVIDIAs, your Googles, your Salesforces, your very big tech names all in one ticker, okay? So this is an exchange-traded fund that follows those biggest tech names. And you can see last year, if you had put all your money into FNGS, you'd be up 95.2% for the year. That's massive. That's a massive one-year move, okay? And a lot of that is what has helped drag the S&P 500, which again here is in green, upwards. Now, if we take the S&P 500 and we just look at the average stock there, the S&P 500 is a little bit difficult sometimes to understand because it is weighted by capitalization. So the biggest companies, the ones with the biggest market capitalization, have the most weighting and therefore have the most influence over that index. And you can see it here. These companies drag the S&P 500 upwards, whereas the average stock, which is measured down here with a ticker called RSP, and this is an equally weighted S&P 500 index. So the equally weighted index was only up 13%, whereas the S&P was up 26%. And you can see as recently as November, it was negative for the year. Okay, it only made that 13.7% move really in the last 2 months of the year. So the average stock last year in 2023 actually had a fairly difficult run right up until the end. And now, the 2-year summary, looking at some of those same allocation funds, the S&P 500, if you go back, instead of looking at it over last year when it was up 26%, and you look at it over the last 2 years, it's only up 3.2%. Meanwhile, your average moderate investor is still negative for the last 2 years. Your average conservative investor is negative for the last 2 years, and your average bond investor is negative for the last 2 years. It has not been a great time to be a conservative investor, at least over the last 2 years. All right, that's 2023 in a nutshell. What is on deck for 2024? Do we really know what's going to happen in 2024? No, but what we do know is that the market doesn't obey the calendar year. The calendar year means absolutely nothing to stocks and bonds. It's an artificial stopping point for a lot of people. What we do know is that a lot of the trends that started in 2023 are going to continue on into 2024. 2023 was kind of the year of the Fed and inflation. So my suspicion is that early 2024 will be that as well. A lot of the talk lately has been that inflation is conquered, that it's all in the rearview mirror, and that the Fed is on track to conquer inflation and move on with cutting rates potentially sometime this year. Well, the authors of one study, which is called, interestingly enough, History Lessons, How Transitory is Inflation, no relation to history lessons for the modern investor, but they analyzed the behavior of inflation across 14 developed nations when rates surged past various thresholds, and then studied how long it took or how long inflation lingered in those various scenarios. Well, when inflation reached a 4% level, the lowest quintile, or the lowest 1/5 of outcomes, took less than 3 years to get back to 2%. That's what the Fed is counting on right now. They're counting on the lowest probability outcome from this study. And in actuality, the median reversion to 2% took 8 years. So if we think that the inflation story is over and that it was only a 2023 thing, I think we're here to tell you that things are going to continue to be challenging from that perspective. So plan on still seeing inflation as being an issue in 2024. Also, the economy, still think we'll probably see some type of mild recession in 2024. U.S. credit card delinquencies are rising. We've got a record high share of consumers saying it's much harder to obtain credit right now. Personal spending is cooling. Chapter 11 bankruptcy filings are rising. Bank lending is declining rapidly. Employment growth is slowing, on and on and on and on. These things are normal. They're part of the progression of a normal economy, but it's certainly a challenge right now. And that's what people wanted. They wanted to slow the economy down. We're certainly getting that. So the economy will continue slowing. Inflation will remain sticky. Rates will remain high. Returns may be muted in such an environment, but it's a great time to be a conservative investor. And I know people out there say, wait, what? Here's why. Since 2010, a 3-month U.S. Treasury bill paid you basically nothing. And now it pays you 5.2%. So just about zero risk to your portfolio. You can be picking up 5.2% annualized. I believe that this is a renaissance for conservative investors. I believe it's the best time since I've been in the business to be on the conservative side of things. Does that mean that growth investors are stuck? No. I just think that the conservative folks are going to be able to get what they need with a lot less risk, a lot easier in 2024.